The broadcast is now starting. All attendees are in listen-only mode.
Ladies and gentlemen, as we start to gather this morning, I want to welcome all of you. We are anticipating over 300, in fact, nearly 350 attendees for today's STR update. And this will take a minute or two to bring everyone into our room. So stay patient with us and we'll begin momentarily. Thank you. Once again, ladies and gentlemen, welcome. We are awaiting the arrival of 350 attendees. Please be patient with us. This program should start momentarily. Ladies and gentlemen, good morning. Happy Wednesday to all of you. I am Rich Maladecki, President, CEO of the Central Florida Hotel and Lodging Association, and I want to welcome you to this STR update. I'm very pleased that we have nearly 350 community and hospitality leaders joining us this morning for this very important update. And we've also invited, and I'm happy to say that we have 13 elected officials also joining us to better understand our new reality, our new world relating to hospitality and lodging. Relating to those individuals that are elected, that are joining us, allow me please to acknowledge that from Orange County, we have 3 commissioners today: Betsy Vanderlei, Mayra Uribe, and Maribel Gomez Cordero. We also have the Orange County property appraiser joining us today, Rick Singh. From Osceola County, Commissioner Peggy Chowdhury. From Seminole County, 2 commissioners, Jay Zembauer, the chair, and Lee Constantine. Representing the city of Orlando, very pleased that Regina Hill is joining us today. And we have 4 individuals from the State House, Representative Smith, Tamkow, Thompson, Mercado. I also want to give a special welcome to Orange County government, the individual responsible for the tourist development tax, and that is Randy Singh. So those are individuals are joining for the opportunity to understand this new reality. CFHLA has had a 25-year partnership with the good people of STR, and I know that all of you understand the importance of STR as a data gathering machine relating to both the international and domestic markets of lodging. Today we will hear an update. It was just 90 days ago, ladies and gentlemen, where CFHLA invited STR to offer an in-person presentation. And that presentation indicated that the Orlando market would probably have a very slight gain of 1 to 1.5% relating to hotel occupancy and ADR for 2020. Well, I say just 90 days ago because obviously everything's changed and a new world is beginning. So the leadership and the board of CFHLA invited STR to offer an update for our Central Florida community. I do want you to know that this presentation is being videotaped, and the video as well as the PowerPoint that you're about to see will be available within the next 48 hours, and your CFHLA staff will send this to each attendee of today's presentation. I also want you to note that at the conclusion of the formal presentation, we will have an opportunity for Q&A, and you can submit your questions to the chat area, and Kim Gordon of our CFHLA staff will serve as the moderator, will read your question to Patrick. With that said, again, I welcome you. Let's hear the Central Florida update, and please, let's welcome our CFHLA friend from STR, Patrick Mayock. Patrick, it's yours.
Thanks so much for that introduction, Rich, and it's good to be with all of you. Honestly, I would like to be presenting this under different circumstances. Rich, as you've indicated, so much has changed in the past 90 days with COVID, the restrictions that have taken place, and its impact on hospitality performance. And over the course of the next 45 or so minutes, I'm going to be sharing data to help you truly understand that impact, and then hopefully give you some updated insights on what you can expect down the road, given that we have a better understanding of exactly what's going on and the effect it's had on hotel performance. So here's what we're going to cover today. I am going to start with just a very brief introduction to who we are at STR and what we do. Rich, you highlighted and welcomed a number of elected officials. I just want to make sure that everyone is on the same page when we're talking about our data and our KPIs, so that they have a fundamental understanding of the data that you will see on the subsequent slides. And then we'll really dive into the meat of the presentation. We're going to start at a global view to show you this unprecedented external shock that is COVID-19 before diving into Central Florida and understanding how COVID has really affected performance in your own backyard. Additionally, I am going to spend some time on some ADR analysis that we have performed in the past that I think just might lend some good perspective and help those of you on the call who are responsible for pricing decisions. It's just some additional data for you that you may find helpful. And then, as discussed, we will close down with the forecast. A few bits of housekeeping, though, before I get started. Something that we at STR can never do is give guidance on price. Given our extensive reach, guidance on price would be construed as anti-competitive behavior. So we are restricted from doing that by the FTC. So just something I wanted to be mindful of. And maybe that will prevent some specific questions coming through. So just getting ahead of that one. And then the next thing I wanted to highlight is we know that out there in the industry, there are a lot of properties that have closed, hopefully temporarily. It's our understanding that they will be temporary, but hopefully that's the case for the majority of them. It's a work in progress getting an updated view on exactly which properties have closed on which dates, and then when they'll be reopening, exactly on which dates. We track close to 67,000 hotels around the world, so you can imagine this is something that we are continuously updating day by day, in some cases hour by hour. So I just wanted to let you know about that. And Rich, as you've indicated, the slides will be available as well as a recording of this presentation. So with housekeeping out of the way, let's dive in. So STR, what we do, we track accommodation performance. And this isn't something that we've just started doing. This has been the core of our business model for over 35 years now. Back then, we were collecting data from a few chains. The business was run out of our founder's basement, but we have grown substantially since then. We now collect individual property performance data from hotels in more than 180 countries around the world. The number of hotels, as I've mentioned, is 67,000, a little bit more. And that in total gets us 9 million rooms around the world that we're getting data from on a daily, weekly, or monthly basis. When I talk about this data, we get a lot of it. We can get anything from hundreds or some cases 1,000 individual P&L line items to various segmentation breakdowns. In short, we collect a lot, but at its fundamental, like the lowest common denominator, we're really talking about 3 basic data points that we collect from each property. The first one is supply. So how many rooms does the hotel have? And if you multiply that by the number of rooms in a given period, let's say 30 or 31 for a month, that's our supply number that we work with. We also capture how many rooms are sold, so that's demand. And then the third main data point we collect is what is the total amount of revenue generated from room sales for a given hotel for a given time period. And from those 3 key data points, we generate our KPIs by dividing demand by supply. We get occupancy as a percentage. So if you sell 7 out of 10 rooms in a given night, your occupancy for that night was 70%. If we divide revenue by demand, we get average daily rates. So that is the average price point at which all of your rooms were sold for the given period. And then if we look at kind of the combined inputs of occupancy and ADR, we get something called RevPAR, which stands for revenue per available room. RevPAR is helpful because it really helps you understand both the demand side of the equation, how many people are staying in your hotel, as well as the revenue side. What are they paying for those rooms? So it's a good overarching KPI that gives you a general sense of performance for a given hotel or market. Of course, we do a lot more than that. We run performance reports. We could do bespoke and customized research studies. We examine supply, what's being built in the future in your market. We do various analyses. And then we also look ahead and we can do different slices of forecast. So that's a quick intro to STR. Again, if anybody has any specific questions about our methodology or what we do and what we don't, feel free to shoot me a note or write a question. I'm happy to answer. All right, so let's buckle up and talk about COVID-19. It is rare for me to do a regional presentation like this and start first at the global level, but that's precisely what I'm going to do because this is unprecedented. And I know we've heard that word a lot in the recent weeks and the recent months. We've heard it so much that it may have lost meaning, but I'll still use it here because the scope and scale of the COVID-19 impact on hotel performance is unlike anything we have ever seen in our 35 years of tracking hospitality performance. And prior to that, in additional research that we've done or from other sources, we find that to hold true as well. The slide that you have up on your screen represents more than 2,000 submarkets in which STR collects data. So in other words, each one of these dots represents a submarket, and this is showing you occupancy percent change. If the dot is green, that means occupancy is increasing, and the more it's increasing, the darker that green will get. And on the other side of the spectrum, if the dot is red, that means occupancy is decreasing for the period. And again, the darker the red, the more significant the increase. And what this first slide is showing you is that we entered 2020 from a relative position of strength. The majority of submarkets here were reporting occupancy increases, and where they weren't, like if you look at here in the States, you see a lot of kind of the light red. It was minor occupancy decreases. From a mathematical perspective, we might even say performance was flat in some of those markets, which wasn't unexpected because the hotel industry has just finished up what was an unprecedented decade-long run of increased performance. Our industry is cyclical, so eventually it was going to plateau. So this was very expected performance to start the year. And as things move along, you'll see a green box I have highlighted over China. So that's where we first started seeing reports of COVID-19. And before long, you're going to see a lot more of these dots turn red, and in some cases significantly red. It was the end of January that we really started seeing government-mandated restrictions on travel, on the ability of hotels to operate in the country and some surrounding regions. So it's not a surprise to see the majority of that part of the world in darker red, indicating significant occupancy decreases. You fast forward a week later, you start to see some of this impact spill over into other areas of the Asia Pacific. But as we progress through February, you look at the United States, you look at Europe, and we're still humming along. Things were bad in the Asia Pacific region, but rest of the world's doing okay. It wasn't really until the very end of February where we started to see significant decreased performance in Italy, which was the epicenter of the outbreak in Europe, or that's where it started, where we start to see the scales turn here. And as I progress, you'll note that at the beginning of March, there were a lot of travel restrictions put in place, and this started to impact hotels throughout Europe. The United States starts to really feel it here. And as I fast forward one more week, the industry is effectively closed, so that by the end of March, occupancy has effectively fallen off of a cliff. Again, this COVID-19 situation is unprecedented in both its scope, meaning that every single submarket around the world has been impacted. We've never seen something like that before, so it kind of goes without saying that the pain you're feeling in your market is not unique to Central Florida. In a lot of cases, there are actually markets around the world that are faring even worse. Which brings me to the second point of the unprecedented nature of this. It's really the scale. So as you're going to see in several slides that follow, unfortunately, we have never seen decreases as bad as they are today. And the not great news is a lot of these declines are going to persist for the short to near term. So let's just accelerate this and include the month of April in our numbers. And this is showing you total US performance for the first 4 months of the year. And you could see the effect this is already having at the national level. Room demand down nearly 30%, the same for occupancy. ADR, surprisingly, has held on for the first 4 months of the year, relatively speaking. In other words, it is not as significantly as bad as occupancy, which has been a positive sign to see, but still told when you combine the decreases in occupancy and ADR, it nets you a 34.3% decrease in RevPAR and very similar decrease in room revenue. What is more alarming is that these numbers here and the level of declines you're seeing are primarily a function of March and April performance. Again, we started the year relatively steady. January was more or less flat. We saw a little bit of gain in February, but the level of decreases we felt in March and then even worse in April have effectively eradicated any gains we made in the first 2 months of the year, and now we're in deeply negative territory. Case in point, let's just look at April alone, and you see these numbers here. We have never seen anything this bad in our 35 years of tracking data. April, in fact, was the worst single month of performance we have ever recorded at the US level. And it's just, quite frankly, it's alarming as you look at the percentage change across the board, down 68%, 63%, with revenues down in excess of 80%. To put it in perspective, the occupancy levels of 24.5%, that means that hoteliers on average are selling 2 out of every 10 rooms on any given night. Historically, the industry runs closer to 65, 68%, so selling 6 out of 10 rooms every single night. So again, we're not in a position of strength. This is unlike anything we've seen before. Case in point, this is showing you the supply and demand trend lines over the past several cycles. If you just look at that very dark blue line, you're seeing demand. And it's really clear to see the past downturns that we've had. In 2001, right after 9/11, the industry saw a very sharp demand decrease. Things bounced back, but then in 2008, 2009, we had the Great Recession. The industry fortunately bounced back even stronger, but here we are today, and demand has just, again, it's really almost fallen off a cliff. And that's what we've seen also when we look at occupancy and ADR. So effective March of this year, everything has really just dropped, unfortunately. And the combined impact here is giving us the worst monthly RevPAR decline we have ever seen in the US hotel industry. This is showing you RevPAR on a 28-day moving average. So we're going week by week, we're giving you a different slice of this. And it's just showing you the long, slow crawl that we've now found ourselves in. If there is any silver lining to this slide, it's that this metric is not as bad as it was a few weeks ago. So you see in the 28 days ending the week of April 18th, we were down in excess of like 80%. We're still down very, very far, but we're not that bad. So maybe this is a sign that the decreases will get significantly less bad, but unfortunately they're so bad to begin with that they'd have to really pull back before we're anywhere close to positive territory. All right, so that is serving as your backdrop. That was the global and the US view. We're now going to shift our attention and focus specifically on Central Florida. For this part of the analysis, the way we're breaking it out, when we look at our data set for Central Florida, we're looking at Orange, Osceola, and Seminole counties. So in the subsequent slides, you're going to see the data broken out that way. So there will be 3 trend lines, 3 bars, each one referring to a different county, as you'll see labeled. And unfortunately, the level of demand decreases you're feeling in Central Florida are similar to that as what we're seeing around the rest of the country. Yes, there's some variation. Seminole County's demand decrease wasn't as bad as Osceola and Orange, but it's still historically bad. So we're just splitting hairs when we talk about who is the best performer of this bunch. Really, it's a matter of who's mitigating the losses most effectively. But no matter how you slice it, you look at this trend line, and we're clearly in uncharted waters. Certainly, leisure demand has fallen away. It's very hard to come by now, as well as just transient demand. So that's I would be traveling by myself someplace. But one of the hardest hit segments here is, of course, group demand, which has, for all intents and purposes, just disappeared. If you look at the group demand percentage change for April of 2020 in the 3 counties, I mean, we're nearing 100%, which is telling you that any group demand that was on the business or that was on the books for the month was canceled or postponed, and we have lost any gains we made in April of 2019. So again, we've never seen anything like this, and on the group demand side, that business is going to be pretty difficult to come by, and that's a significant driver of demand in many markets. So that's kind of the demand portion of what we're looking at. Again, I did also want to highlight the supply portion of this. I told you at the beginning of the presentation that we are doing our best to track temporary closures around the country and around the world. And for the top 25 markets and Central Florida, you could see the year-over-year change that we're feeling in supply as a function of operators closing their properties. In a lot of cases, these closures have been mandated by government agencies. In a few other instances, they have been voluntary, so as to save on the expenses required to run a hotel. But again, you just look at the top 25 largest markets in the country, and in some of them, we have closures in excess of 30%. So just 30% of the room inventory has been taken offline effectively overnight. In Orange and Osceola, they would count among some of the markets with the most significant closures when we look across the country. Seminole County, not as bad, but it just gives you some understanding and some perspective of what we're dealing with and how operators are responding. And in some cases, that response has been to temporarily close the properties altogether. Pricing power has been very hard to come by in this environment. So you could see the trend lines for the 3 counties here. We see that pricing power, again, really hit the skids effective in March. And then I'm giving you the ADR % change for April for the 3 markets, for the 3 counties. So Seminole County in April experienced nearly a 30% decrease from where the county was in April of 2019. And then for Orange and Osceola, down 53 and 55% respectively. What's interesting is that, or interesting or perhaps fortunate, is that these ADR decreases have been significant, but they have not kept pace with the level of decreases we've seen on the occupancy side. And when you look at where occupancy was for the 3 counties, that's a very good thing. I will tell you that this is not a surprising phenomenon. When we, as a hotel industry, experience external shocks in the system, the first thing to go is typically occupancy. So occupancy as a KPI is much more volatile because travelers could effectively just make their decision the night before or the month before not to travel. It's a lot easier, or travelers are a lot faster in responding to these shocks. And you see that play out in occupancy, meaning that occupancy, when it goes bad faster and further than ADR. But on the flip side, when occupancy recovers, it recovers a little bit more quickly and more significantly than does ADR. And we'll spend some more time on that point here a little bit later on in the presentation. While we're on occupancy, though, let's just show where the 3 counties have been the first 4 months of the year. So this is not % change. This is just the absolute levels of occupancy for the 3 counties. And as you can see, for Orange, Osceola, and Seminole County, they came into the year relatively strong in the 60 and 70% range. And then in February, saw an appreciable increase in occupancy for the month. But then March comes along, government net mandates and travel restrictions begin to take place, and occupancy really takes a hit that gets even more severe as we report April data. So Orange and Osceola, let's just call it 15% occupancy for the month, and Seminole County faring a little bit better at 27%, a little bit being a relative measure at this point because 27% occupancy is not good occupancy. When you kind of just think historically about where the county traditionally is. So with occupancy being down so significantly and with ADR decreasing as well, this is where we've landed for RevPAR. Like the slide before, this is showing you the absolute level of this KPI as opposed to the % change. And unfortunately, RevPAR for all 3 counties is now less than $20, which again is kind of a historical low. It's not where we'd want to be. And just based on the trend lines here, you can see how far and how significant that decrease has been, and really how suddenly it's come on and taken hold. Again, just a quick point of perspective for you. These RevPAR decreases and levels of RevPAR are not unique to Central Florida. We kind of expand back out. We look at our top 25 markets. The top 5 lines of this chart are showing you the quote unquote best RevPAR performers, and then the bottom 5 are the worst RevPAR performers of the top 25. But even the best aren't doing well, reporting double-digit RevPAR decreases across the board. Miami, to its credits, has staved off some of the significant gains of RevPAR, as has Orlando on a relative basis. But when you're down 31%, It's still not a position anybody wants to be in at this point in the year. Okay, so that was performance in Central Florida. And next, I'm going to turn your attention to some analysis that we have done that has looked at average daily rate, and more specifically, some of the psychologies of pricing. And in this next section, I'm going to do this in two ways. I'm going to be sharing with you results of two separate studies we did. The first is looking at specifically at pricing psychology and what hoteliers do in an environment when their competitor is slashing rate, and you have to make a choice about how you respond to that. And then the second, we're going to look at the two most recent downturns to understand, as rates drop at a national level, how long does it take for the hotel industry to regain the rate share that they've lost? So let's start with the pricing psychology. And this was a study done out of our consulting and analytics office in Colorado. And it was based off of a lot of things that we were hearing during the Great Recession. We know by looking at the data that ADR plummeted in 2009. We know that demand declines came first. Like once hoteliers stopped getting as many heads in beds, they started cutting their rates in an attempt to hopefully induce more demand. And we also know that during the Great Recession, no major markets were immune to this. So all of the major markets in the US reported ADR decreases. It just depended on how severe they were, one market compared to the next. And what we heard anecdotally was that hoteliers wanted to hold their rates. They didn't want to slash their rates, but when the competitor across the street started decreasing rates by 10, 15, 20%, that the competing hotelier had no response other than to follow suit. If I'm competing with a property across the street, that property is offering rooms for $70 a night, it's hard for me to charge $100, or so the thinking went, and so the anecdotes we were hearing. So we wanted to test that out. We wanted to understand, first, was this actually true? Like, could we see within a competitive set of 4 or 5 hotels, was there really that one rogue hotel, the one that slashed rates initially, thus sparking a domino effect and downward spiral of subsequent rate decreases? So that's what this analysis is looking at. And just to be able to wrap our arms around it, we chose Chicago as one market. We did this analysis in others as well, and generally the findings all were fairly consistent here. So I'm just going to show you Chicago today for the purposes of time. We looked at daily data from 2008 to 2010. And just as a point of definition, when I talk about rates being slashed, it's defined here as an ADR drop of 10% or more. So as soon as they get to 10%, we're saying this hotel effectively has, quote unquote, slashed the rates. You're going to see this play out in this chart. This first line is, well, first of all, this chart's going to show you 4 hotels in one competitive set. So these are all 4 properties that are effectively fighting for the same guests to stay in their rooms. Property number 1 is represented by the purple line, was the first property to, quote unquote, slash the rates. So when they reach that 10% decrease in ADR, that's our day 0. So we're going to measure from that point, how long did it take the other properties in this comp set to also, quote unquote, slash the rates. And you could see it play out here. Every single hotel in this comp set effectively hit that slash threshold. There was no one who was able to maintain rate increases or to mitigate the rate decreases of less than 10% in this case. But they did price differently and were able to stave off at what point they hit that slash zone. And the time between the first rogue hotel doing this and the second hotel was 26 days. And then it was effectively 57 days until the 4th property did it. If we expand this out, and the previous slide was showing you one comp set, and in this example, we're showing you data for every competitive set that we track in Chicago. There was a fairly consistent results. We looked at these, the vast majority of them did end up slashing the rates, and we did see this a relatively similar time period in terms of the first property hitting that slashing threshold, and then the subsequent members of competitive set following suit. And what we found when we looked at all this data is that the third and fourth hotels in the comp set were willing to take a greater decrease in occupancy as a result of holding their rates. So they're making a choice here. They're saying, I want to keep my rates more consistent to get as much room as possible, as much revenue as possible for a room sale, knowing that in doing so, I may see a dip in occupancy. And at its lowest, at the lowest RevPAR drop, you can see how it plays out. You have the first and second properties in the comp set, which experienced only like a 7.5% decrease in occupancy, but when all was said and done, they saw more significant decreases on the ADR side, whereas the third and fourth hotel, the ADR decreases weren't as bad, but they saw more of a hit on occupancy. So what's the lesson that we can learn here? It's kind of a simple one. Hotels that were more disciplined in their pricing policies saw a greater hit to demand, but when all was said and done, they experienced less extreme RevPAR declines. So they didn't have as strong occupancies, but from a revenue and profitability standpoint, they fared a little bit better. I'm sharing this data with you just as something to think about. And I will say this isn't the case in every competitive set in every market. This is our top line results when we look at this particular case study of hotels in Chicago. So of course, within each individual comp set, there may be some variations, but that's generally what we saw, is that pricing discipline during the Great Recession resulted in a better RevPAR when things got really bad. Turning our attention now to the second analysis, this one's a bit more straightforward and quick to present because we're just measuring after ADR decreased, how long did it take to recover after one of these major external shocks? The first one in recent memory that we can look back to was 9/11. And if we looked at 12-month moving average ADR, we saw effectively a decrease for a whole year. So ADRs fell from September of this period, then through the September of the next year. So we're talking a 12-month period in which ADR continued to decrease month over month. How long did it take us to get back to that $85 level that we entered that downturn in? What we found was it took about 2 years. So 1 year worth of pain took about 2 additional years just to make up the ground of where we were when we entered that downturn. Next, let's take a look at the Great Recession, and we're defining our day zero here as the Lehman Brothers bankruptcy, which really precipitated much of the impact of the Great Recession. We entered this downturn with ADR at the national level hovering about $108. After the bankruptcy, ADR decreased for 19 consecutive months. And in this particular recovery, it took the better part of 3 years just to get ADR back to where we were. So again, we anticipate and we're seeing ADR decreases as a result of COVID-19. None of that's surprising. But whenever we're looking at this data, we're also thinking ahead when we're doing forecasting or talking to clients around how long is it going to take to make back what we've lost. And I told you earlier in this presentation, occupancy is more volatile. It goes down farther and it goes down deeper when things get bad. It also recovers much more quickly. ADR takes a lot longer time to recover. So we'll continue to monitor this, see what the impact is. Hopefully it doesn't take as long as what we saw for Lehman. Which brings me next to the forecast. So what are we anticipating for the remainder of 2020 And then what can we expect going into 2021? Now, for those of you who have attended previous webinars of STR, or if you were at the Central Florida Hotel and Lodging Association luncheon in February, you have seen our forecasts before, but you've never seen it broken out this way, where we're giving you two supply figures. So I just wanted to pause and kind of quickly explain the methodology here, because it does matter. So we're showing you supply and economic supply. Supply is basically who is reporting data to STR. So in 2020, there have been a lot of hotels that have closed temporarily, which means we're not recording data for those rooms being available. Effectively, if you kind of look over the course of the entire year, of all the total number of rooms that are available for sale, if a property closes, you subtract those rooms out of that total pot. And what this is telling us is that for the US level, year end, this supply number is going to be down 5.2%. However, we also know that hotels don't just disappear. I could temporarily close my hotel, but those rooms are still effectively sitting there. So we also have economic supply. Economic supply is more easily understood as, Econ 101 supply and demand. It's factoring in all of the rooms that are available, regardless of whether or not the property is temporarily closed for a period of time. And for 2020, you're seeing that we have forecasted a 1.4% increase in economic supply, which makes sense because new hotels are still going to open this year. We had a number of new hotels open in January and February. And for a lot of these projects that are under construction, if they're 95 or 98% of the way done, they're not just going to pack up shop as a result of the pandemic. They're still going to finish the project. They're still going to open the hotel and try to ramp up as best they can. And as a result of that new supply coming to the market, the true economic supply that we forecasted is up 1.4%. Now, when you look at the rest of our forecast, particularly as it pertains to occupancy and RevPAR, we are looking at the true economic supply. That is what's driving both of those KPIs. And you can see here what that means. So we're, for this year, expecting occupancy to be down nearly 46%. And combined with that more than 20% decrease in ADR, at a US level, we're forecasting RevPAR to be down nearly 60% for the year. Again, it's not promising numbers. The data, quite honestly, looks just terrible. There's really no other way to describe it for 2020. So that's the bad news. The good news, though, is just move your eyes over into the next column. For 2021, we are forecasting significant increases across the board. That's not us saying that the US is going to be back to the level it was before entering this downturn. To be honest, it's probably going to be until 2022, 2023 in some cases, before we're back to kind of the level we understood to be normal in 2019. But at least the numbers will be moving in the right direction. This slide is giving you the same forecast. It's just showing you, instead of the percentage changes, what are the absolute levels that we are recording. And here for occupancy, we think the year is going to end with occupancy at about 36%, which is down significantly from the 66% we ended 2019 with. But again, the good news, 2021, we do expect things to begin to rebound, and occupancy will not be at 2019 levels, but at least it's not getting any worse, and we've seen an increase. And then the similar trend lines are being followed for ADR and RevPAR. You see the absolute values are down significantly for this year, but fortunately they will begin to crawl back by 2021. And I use the word crawl because just look at that increase in ADR that we're forecasting. After experiencing a nearly $30 drop from 2019 to 2020, we're saying that in 2021, we're only going to be up $2. So it goes back to the previous part of this presentation. It's easy for rates to go down, it takes a lot longer to recoup the losses that we've sustained. And just for the point of comparison, we're showing you where we were for all these KPIs in 2010, a decade ago. So it just helps to put things back in perspective. That is the total US forecast. Here's what we've got for Central Florida. So this is the forecast that combines all 3 counties. And it's, unfortunately, it's similar trend lines to what we saw at the US level, with everything down double digits, significant double digits, with rather dour actuals reported for the end of the year. For each of these, I just wanted to give you a little bit more detail about, like, how is this actually going to play out on a monthly level. So that's what the next 3 slides are going to show you. This chart right here is occupancy actuals, and then as of April, like what we have forecasted for each month over the next 18 months. So we do expect that April was kind of the bottom, that the level of decreases we saw in April are not going to be as significant for the rest of the year. Unfortunately, for the rest of the year, when we talk about occupancy, we are talking about significant double-digit occupancy decreases on a year-over-year basis. And that's going to persist for the entirety of the year. So it's just a really important message to try to get across. Things will hopefully get less worse, but they're still going to be bad for 2020. We are forecasting the rebounds in Central Florida from an occupancy perspective to really ramp up in March of 2021 and then hit its peak in April of 2021. And you see that triple-digit increase we have forecast there. That's not a typo. That's just where the math ended. I've never had to share a triple-digit number in any of my forecasts before, so this is a bit of uncharted territories. So really the message here is we've got to just kind of buckle down, prepare for a tough slog ahead, but then come to this point next year, we're all going to be popping champagne when we report the highest ever occupancy ADR on record. If we just switch to ADR, again, this is 6 months of actualized performance, and then we look ahead 18 months of what STR is forecasting on a month-to-month basis. It's really more of the same. The only difference here is that the ADR decreases we're forecasting on a monthly basis are not quite as bad as what we forecasted for occupancy. So the occupancy decreases were down in the 80%, 70% range for much of this year. On the ADR side, we're talking down 50%, 40%, and then like 30 and 20% by the end of the year. We will be back in positive territory starting in March of 2021, and then just like occupancy, hitting our peak in April of 2021, not quite at the triple-digit level that we saw on the previous slide, but a 74.1% gain will be a record in the market. I'm going to signal that hopefully things are back on the right track. And then last but not least, here's a look at RevPAR. So the prior slide was showing you the percent change year over year. For RevPAR, I wanted to give you the actual revenue per available room as measured by dollars. So just to kind of show you how far and how much of a crawl this is going to be to truly rebound, you can see that in February of 2020, RevPAR in Central Florida landed at $123. So if that's the benchmark, if that's what we're trying to get back up to, we don't have it forecasted over the next 18 months that any month is going to be really approaching that $123 threshold. But the good news is, after sustaining losses in 2020, we do expect a rebound. We'll start seeing increases as of March, April 2021, and the increases will continue. It's just going to take some time to get back to these 2019 levels that we had gotten used to for so long. So that's the forecast. I've got just 3 things I want you to remember before, Kim, I kick it back to you and we can go through some questions. So what should you remember from this presentation? The first takeaway really is that performance is down across the board. I know this is from a hospitality perspective, more painful to sustain than anything we've seen in prior downturns. But I think some operators are taking solace in the fact that it's not a result or a reflection of anything inherently wrong with your market. This is a truly global pandemic, unlike anything we've seen before in both severity and scope. The second point here is that ADR, again, is slower to fall. It's less volatile than occupancy, but on the kind of upside of that, it takes a lot longer to recover. I showed you two analyses, one talking about pricing psychology and the other just giving you the timeline of rate recovery. And you saw that to hold true in both cases. A month of ADR decreases in the analysis, as we saw, translated into 2 months just to get back to where we were. So the losses that we experience over the next year on the ADR side, it's going to take quite a while to get back and make up the ground of where we were in 2019. And last, your third takeaway, unfortunately, and as you saw in the forecast, expect the decreases for a while, at least through 2020, probably into the very first portion of 2021. The thing you're going to want to be monitoring, though, is to what extent are these decreases getting less severe? So we would hope and expect to see still significant decreases, but on a month-to-month basis, each decrease a little bit better than the month before. And as those decreases pull back, we'll eventually get back into positive territory in March, April 2021. And then at that point, it's all about recovery. It's all about increased KPIs. And that's the data that I'm going to really look forward to sharing with all of you on the upside, telling the story of this robust industry really rebounding and getting back to where we were. So with that, that's everything I had prepared for the presentation. Kim, as you pull up some of the questions, I did just want to note, of course, you're welcome to reach out to Rich and Kim, your representative of the Central Florida Hotel and Lodging Association, for any information. But if you did have additional questions, I'm always available as well. On this slide, you see my email address, pmayock@str.com. Don't ever hesitate to reach out, and I'll do my best to answer. But for the time being, did we get any questions?
Yes, we did. Thank you so much, Patrick, for all of that important information. So we do have a few questions. Before we go into that, it has come to my attention that Orange County Commissioner Emily Bonilla has joined the seminar. So thank you so much for joining us, Commissioner. So with that, we will go into our first question, which is, wouldn't the ADR change be affected by what hotel tiers are open versus those closed?
Yeah, that's a great question. You know, we've done some analysis around that as well. And there's a little bit of that playing into it. So the traditional group boxes, major group hotels, which historically skew towards the higher end, luxury, upper upscale. For all intents and purposes, those have effectively closed down, not getting as much business. And what we have found is that the lower end chain scales, brands in the economy and the mid-scale tiers, have sustained this downturn a little bit better, meaning their occupancy numbers look a little bit better, which means they are the one that are realizing rooms revenue, meaning there's a bit of a skew in the overall numbers, but we are splitting hairs when we talk about it at that level. Across the board, when you just look, regardless of brand, regardless of chain scale, the level of decreases have been so severe that there has not been any tier or any pocket of the industry that has really been immune to this. So yeah, the lower ends are faring a little bit better. We're seeing more of an impact from the higher end, but again, that's splitting hairs, so to speak.
All right, so our next question is, would that philosophy of holding rate be realistic in such competitive market like Central Florida?
You know, that's a good question, and not one that I can necessarily answer. When you talk about, you know, the pricing pressure, the only thing we can really do is look at the data and see what it's telling us. And we do know when we did this pricing psychology analysis, whether it was Chicago or some of the other markets we look at, we do see in the data that it is hard for members of a competitive set to maintain rates when a rogue property or several properties in the set have begun to slash rates. So that's the story that the data is telling us. So I would certainly expect that to be true. But in terms of the actual psychology around that, it's a little bit hard for me to comment on.
Okay. Our next question is, do you feel the industry will be able to bounce back quicker in ADR than past events, since this event is one we have never seen in history? This just happened so quickly and the decreases are set up to be temporary.
It's a great question, and I can tell you that when we look at the macroeconomic lens, a lot of the macroeconomic modeling at first was projecting a more rapid rebound. And I mean, like using the same rationale as the question implied, that the drop off here was so severe, and it was a result of just a very sudden shutdown, effectively, of the economy, that the subsequent recovery would maybe not, come back quite as quickly, but certainly would come back more quickly than what we sustained in prior economic recessions. And that may be the case. Like, that would be great if it played out that way. I think some of the economic modeling has pulled back from that early optimistic view, just because the economy has sustained such significant damage during this shutdown, that it's not like you can just turn a lot of businesses back on. And I can tell you that some of that thinking seeps over into the hotel forecasting when we think about it. And then also, we just can't help look at every other downturn we've ever seen, or every other market-specific shock, such as a natural disaster or other factor. And uniformly, it just always takes longer for ADR to get back and running. And there's a lot of things you could point to there. It might be some of the psychological factors that the other person was asking about. It might just be a resistance from travelers themselves. So after you see certain prices being offered, you're not going to pay for something significantly more than that. So I think that is best case scenario, and I think everybody would like to see the industry rebound as quickly as possible. But our forecast is just showing us, to the best of our knowledge, to the best of our thinking, we're still projecting a pretty long crawl back on the ADR side.
The next question is, do you anticipate that vacation rentals and homes will have a possible increase of business versus hotels due to those people looking for a vacation with the least amount of contact as opposed to a typical hotel?
It's a great question. It's something that we monitor. I don't have any data to speak to this, but here's what I can tell you from like everything that we research and everything that I've been able to read. First, the short-term rental industry has sustained significant pain as well, so that it's not like they've gone through this unscathed. In fact, there's a lot of fairly established short-term rental companies. I say fairly established for that space, meaning they've been around for 6 or 7 years. They were some of the more well-known brands in the space, and they've either shuttered or they've had to do significant decreases in workforce, significant decreases in listings. So in some ways, that space was less equipped to deal with the impact of this than others. So it's going to be interesting to see, like, well, how does that space recover if a lot of the key names are no longer there and operating anymore? So that's the first thing. And then the second thing is, the short-term rental industry has a lot of challenges when it comes to making assurances about consistency of the things that travelers take for granted on hotels. So basic house cleaning services, for instance. It is very easy for me as a traveler to go and do very quick research to understand what is Hilton doing to ensure proper cleaning of my room? You know, after somebody stayed there the night before, I'm going to stay there today. And here's all like the things that Hilton's doing to ensure the room is as clean as it possibly can be. I can look on Marriott and get that information. I can look at Hyatt, and that's all done consistently. They all have professional housekeeping services on staff, and this is like just basic nuts and bolts operations that they've been doing for decades and decades and decades. It's a lot harder for me as a guest to understand, well, but what are some of these short-term rental providers doing to offer that same level of insurance? Like, even if the most well-known names and brands in the space are issuing cleaning guidance and other things, like, I don't know if the person I'm renting from is going to follow those to a T, or whether or not they're trained to follow those. That's not to say that professional property managers aren't doing those things and offering the same assurances. I think it's just a degree of comfort for travelers. So yes, short-term rentals, it's more isolated in some cases, but I think you've got to look at both sides of the coin. And ultimately, it just comes down to what are travelers most comfortable with. Some will like the more standard nuts and bolts operation, a brand name that I can trust and I have more confidence in, and others may weigh more heavily the isolated stay experience and things of that nature. So we'll continue to monitor because that's one that's of keen interest to us as well.
Great, thank you. So our next question is more of a comment too on the market comparison slides. I didn't see Las Vegas on the market comparison slides. Did I overlook it?
No, it's a great question. You did not overlook it. So Las Vegas is a bit of a wonky market. We do track data there. We track demand and supply. But the pricing structure of Las Vegas hotels is different than anywhere else in the country. And if you've stayed at a hotel in Vegas, I think you'll know why. Just in a lot of cases, those rooms are comped, or the rooms are offered at a significant discount because so much of the revenue at a Vegas casino hotel is generated from the casino, or it's generated from other things. So when we talk about our top 25 markets and look at performance, we exclude Vegas because the KPIs always look a little bit weird just because of how those models work. They are just a little bit separate and apart from the way a lot of the other markets in the industry operate. And for that reason, and to avoid confusion, we exclude it when we talk about top 25.
Okay. This next question, I'm not sure if you can answer it, Patrick, or Rich, I can unmute you and maybe you can help answer this question. The question is, are hotels getting any funding from government to help them survive?
Well, I guess I'm going to answer that question since nobody else is. And yes, through our various communications with the lodging community, I have heard of dozens of examples of our Central Florida lodging establishments receiving some sort of aid from the federal government, whether that's the PPP, whether that is other support mechanisms. So that goes back to the individual lodging executive and their corporate offices. I would suspect that there may be a second wave of funds that could be available later this summer. So I would encourage everybody to speak with your corporate offices and your ownership teams relating to looking at that opportunity.
All right, great. Thanks, Rich. Okay, so our next question is, in the last Great Recession, how long did it take RevPAR to get back to its previous peak? You highlighted rate, but not RevPAR.
Boy, you know, Kim, it's a good question. It's something I wish I would have included, and I don't want to misspeak. I'm not having the data in front of me. I can't say for certain. I can tell you that occupancy recovered much more quickly than the rate side, and given that RevPAR is a function of occupancy and rate recovery, RevPAR from an absolute level probably was on pace to ADR, maybe a little bit more quickly. but it's without having the data in front of me. I apologize. I can't say.
Okay. No, we appreciate that. Thank you. Okay, so we have two more. Oh, so we just want to say welcome to Commissioner Maribel Gomez Cordero. Thank you so much for joining us today. And our last question is, has the CARES Act had a significant impact on keeping a lot of hotels from closing permanently, or is it too early to tell? And it looks like this is from Representative Joy Goff Marcel. So thank you for joining us as well, Representative.
For that one, it is too early to tell. So we are monitoring these closures very closely. And I mean, when I said that earlier, that we're looking at it every single day, I wasn't lying. And we look at this a variety of ways. We check in on relationships with hotel providers, owners, investors, with major brands, because we're trying to closely monitor this. And I can tell you that the vast majority, like almost across the board, when people have reported closures to us, they've reported them as temporary status. If anyone has come in and said, we're just shutting our doors down for good, I don't even know of any instances like that. I'm not saying it hasn't happened, but it would be such a small fragment here that we couldn't really answer definitively. With government restrictions being lifted and states beginning to reopen, we'll have much better clarity on this question, I'd say over the next quarter. So that is when we will begin to see our hotels operating on the days and within the timelines that they have previously communicated to us. And if they're delayed in reopening, why would that be the case? The last thing I'll say on this point is if a property does close, let's say one owner just can't sustain the loss, or they just want to be done with it, and let's say they walk away. In most of these instances, somebody else will come in and use that as an investment opportunity. So it's not like we're going to see a significant number of hotels close for good. If any of them do kind of permanently close, those represent acquisition opportunities for other investors to get them back up and running again. Yes, there will probably be a handful. Sometimes a hotel is, maybe it's decades old, or it just doesn't make sense from a numbers perspective. But we are expecting the vast majority to reopen. That's what our partners are telling us, but we'll know for sure over the next couple of months.
Okay, so we're gonna start wrapping this up. This will be our last question. Any anticipation on when group demand may return?
Again, that's a really good question. We track the number of events at a global level that were postponed or canceled. We saw a lot of cancellations outright. I mean, we're talking hundreds and hundreds of events because the events industry effectively shut down when this was at its worst. We have noticed that a lot of these groups have been pushed back to late Q3, and then even more of them in Q4. There's still, and even though for the ones that weren't postponed, the events that were planning to happen, most of them are still on the books. Now that said, we're also aware that major corporations have gone in and they've introduced their own restrictions and safety measures, limiting the number of people they want to meet in one place. So that invariably will have an impact. But safe to say, I think the kind of like the group demand portion of this, it's going to take longer to come back than what we see on the transient side. So the way this is probably going to play out is we're going to see leisure travel start to creep back, targeting the weekends. Corporate travel will then follow suit. And then like the last major piece of this most likely will be group demand. And then I guess the one after that will be international inbound, because there's some concerns there as well. The exact timeline, hard to say with certainty, but you know, you saw the forecast of what we were projecting on occupancy. and those significant gains that we project in 2021 and then later on through the year, that can't just be all leisure driven. So expect some portion of that to come from the group side as well.
All right, wonderful. Well, thank you all you had great questions. Thank you for participating. And Patrick, thank you so much. That was our last question. Just a reminder for all those that have been asking, yes, we are recording this and we will send out this recording and the presentation to everybody within the next 48 hours. We just got to make sure we go through and make sure everything is all good with that. So again, thank you so much, Patrick, for being here and presenting to us. Great information and presentation as always. We do appreciate you and all the support that you give to CFHLA. And with that, if you have anything else, I think we can wrap it up.
Thanks so much for having me, Kim and Rich. It's always a pleasure.
Thank you so much. And Rich, do you any last words?
I want to thank all of you for the time you invested this morning to better understand the state of our Central Florida lodging industry. Patrick has been a wonderful friend of CFHLA, and I salute the STR people for giving this presentation to our community. For all the elected officials that have joined us today, I hope this also helps you in relation to better understanding the state of our tourism industry and projections for our immediate future. I want to thank you all. I wish you a good day. Stay dry. Thank you.